Hello everyone, you're welcome back. It's Chris here, and I'll be your friend, your host, and your tutor. You're welcome to the last video of 2025. 25 trading lessons for the year 2025. So in this video, in no particular order, I'm going to be sharing the 25 trading lessons I had to learn to make me a better trader, or the 25 trading lessons that the market had to force into me before I became better. So in no particular order, we're going to start. So if you're seeing my, hold on, okay, all right, so I believe everybody can actually see my screen. Sorry, I'm on the 12 months time frame. I was just showing a friend something. So let's go back to our usual time frame lesson, our usual time frame of lesson, which is the H4 time frame, or just go to the daily time frame. I'm going to clear all my previous drawings, and we're going to actually start discussing. So what is the first trading lesson on our books? The first trading lesson is number 1. Market structure is the foundation. Market structure is the foundation. No structure, no bias. Now, all my years trading and being a mentor, when I actually see people actually lose trades, and they lose trades consistently, not just because it's one thing to lose a trade. Every trader loses trades. It's one thing to lose a trade, but it is another thing to lose a trade consistently, or to lose trades consistently. Now, the one thing I have noticed in many of them is that they do not realize that sometimes the problem is them, or sometimes the problem is a system is lacking something, right? And the major thing I have come to note is what? Lack of proper market structure, right? Or lack of direction, because the structure is the direction of the market. If you do not know where the market is headed to, there is no bias at all. When I get on the chart, I need to be able to tell myself, oh, Race, the market is going to come to this place. If the market is coming to this place, this is the reason why I want to trade. Because if I do not know where the market is going, I do not essentially know what to trade. It's like you're entering like a you booked a boat without a direction. Before you book a boat, or before you book an Uber or whatever it is, you need to actually have a place in mind you're going to. That is how the market works. If you're coming into the market, you need to have you're going to need to just come to the chart, look at it as it is now. We are looking at this whole thing. We're looking at this whole market. What can we actually see? What can we actually infer that the market is going to do next? Do you understand? Right? Now, when it comes to directional analysis, you need to understand two things. There is pro trading. Sorry, I'm going to be drawing with this pen, so my handwriting is not the best on screen, but my handwriting is the best in real life. Don't worry. There is pro trend trading, trend, 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 pro trend trading, and then there is counter trend trading, right? Counter trend trading, right? So now this one means you're moving in the direction of the market. So let's say the market is intending to go up, Race is only going towards buy to the upside. And this has actually formed my bias throughout the entire year. I don't think I've taken any successful counter trend trades, although there are people who do it and they do it very well. So it's one thing to actually know that this actually exists. I don't think I've taken any good counter trend trade, but majority of my trades have been pro trend. When I spot where the market is headed to, all I need to do is just what? Justify every other trading criteria I use for my books or my trading plan. When all of this has been justified, I look for my entry. I either market execute, or I wait for confirmations, or I even set limit orders, right? Now, a counter trend trade is, let's say the market is preparing to go up. Like, let's say we have a break of structure, okay? Right? And we formed a new target. Let's say the market is intending to come back up here. A counter trend trader is not interested in trading the market to this place. So he's not. You know what he's interested in doing? A counter trend trader knows that the market is supposed to come down below this break or structure level, or come down to the discount level, seek points of interest before going back up. Now, a counter trend trader is only interested in maximizing the move from here until the POI. Now, this one is very risky for beginners, because you never can tell where the market gets to and it starts to reverse, right? So it is very, very, very risky for beginners. That's why my beginners, I tell them, please stick to pro trend trading. Just stick to trading the direction of the markets. This is the easiest, because when you're wrong, you know, okay, yes, I probably did not follow the market's direction. And the thing is, many a times, I'm going to give you a very pro tip that helped me this year. Many a times when you're trading and you've been taking so many losses, listen, you've been taking so many losses, sometimes you do not need to keep forcing things. Take a step back and reanalyze or reassess. The reason why you're taking those losses is because you have a very short sight about what the market is doing at that point. And this is where the market actually makes the most money from inhesitant traders, or yes, inhesitant traders who are so quick to wanting to get into the markets. The market makes a lot of money from them. You know why? Because they're always in a hurry of taking the next trade. They want to take the next trade. They want to make the next one. They want to just go fast, right? And many a times this can actually this can cause a lot of problems in your trading account, and you're going to lose so much money after a stop loss. Even sometimes some persons like to give themselves benefit of doubt and then take up to 2 losses. After a stop loss, techies would pause and reassess, because a stop loss is like would I say it is a stop loss is like giving you a feedback that something you did is not wrong. Something you did is wrong rather, right? Because if I take a stop loss after I have justified the trade completely, and I take a stop loss, it simply means that, oh, techies, you're probably short-sighted, because you cannot win every day. Even me myself, I can't win every day. So when I take stop losses, I tend to take a step back and ask myself, okay, why did I take this loss? Was I doing something in the right direction? Was it a POI selection problem? If it was a POI selection problem, what I'm going to notice is that the market is going to go back in my direction after stopping me out. But if it was not a POI selection problem, the market is going to keep dropping and dropping beyond my POI. Do you understand? So these are some things you need to actually note. So I'm going to share a few more things on market structure before we actually proceed to the next tip. This video is looking very, very long. This video is looking to be a very long video, so I had to just put on the thermostat in the room. I had to take it up. All right, so now the thing you need to notice about continuation trades. Now, when the market breaks structure to the upside, this break gives you it tells you that the market is interested in taking more buys to the upside, right? Until this low has been taken out, we are not expected to actually see sales, right? We are not expected to see sales. So the market is supposed to return back to a discount level, seek points of interest, and then move back up. That is how it's supposed to be. Now, there are 3 things fundamentally that I actually like to teach my students whenever I'm talking about market structure. Break of structure is number 1. When a break of structure has happened, we expect price to move in the same direction. A break of structure inherent a break of structure is supposed to take price to the same direction. While we have what we call change of character, and change of character can come in so many forms. It can come in form of reduction in momentum, can come in form of expansion breaks, can come in form of so many things, right? A change of character finalizes the trend. Now, let's say you have a huge ass trend, because we have what we call major trend and sub trends. A major trend happens on a much higher time frame. A sub trend happens on a much lower time frame. Now, let's say we have this on a major trend, like we have a break of structure, and we have highs. You know that, in fact, sometimes even in 6 months, we can still be dropping down to the points of interest of the major trend. On the sub trend, we can be dropping down until we get to the major trend points of interest. Now, when you see a shift in market structure, that could be a sign that the market is actually prepared to go up. So it happened recently on Euro USD. Let me show you. Now, if we actually pinch these charts, by pinching I mean we zoom it in very well. Hold on, let me take this off. We are going to notice something. Hold on. Okay, so this is the daily time frame. Now, this is we had price drop. This was where we had our first change instead of delivery. Markets came down back, mitigated this POI, and we had price make the second change instead of delivery. This second one is a confirmation the market is going up, and it didn't even have time to come down back. The market just kept going up. Now this is a new trend that has been formed. Higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, right? Higher highs, higher lows. Now I'm not taking account of the sub trend, that's a trend happening inside, because this is a daily time frame. I'm just taking account of the major trend. Now this is the higher low, right? Because it's higher than this low. And then we had what? Another higher high. We had a break. Now this break on the daily time frame, it simply means that the market is going to what? Come down back, seek points of interest, and then go back up again, right? Now the market would actually start aiming to return back to this high, right? So you see one thing about the market structure, if you actually do not understand market structure, you don't even know where the price is going. There are so many other things you need to actually learn. It's not just market structure. There's so many other things you need to learn that adds up, because when you talk about markets, when you talk about POI selection, you need to now learn mitigation, you need to learn premium and discounts, you need to learn the types of points of interest. There are fair value gaps, the breaker blocks, which I don't use often, but I use fair value gaps, other blocks. There are rejection blocks, which I use often. Perhaps there could be a video on them in the future, but you get the point. When market structure does not exist, there is no bias. Okay, there is no bias. Now this is what I was telling you guys. Now this is the move. Now this is the move that happened on the substructure. You can see how the market was making lower lows and lower highs, until what happened? Until the market did this. Boom. Can you see the shifts in market structure? It happened here. Shifts in market structure happened here. Now, typically, we are supposed to expect the market to come down around this zone, but this is where your knowledge of mitigation comes in. If there are no unmitigated points of interest around here, the market would have no reason to actually come here, right? And you can see what the market did. It just dropped down to this place and boom, went up again. Can continue to drop down a little bit, boom, go up until we take out this high. Market structure is the heartbeat of the market. Market structure is the heartbeat of the market. Without market structure, I truly don't know what you're doing. In fact, if you have good knowledge of market structure, you have solved 70% of your trading problems, because every other thing just adds up. Right? Every other thing just adds up. So next time when you take a loss, zoom out. This helped me in 2025, and it should surely help you in 2025. We have spent 13 minutes talking about just 1 point out of 25 points. I need to rush the remaining ones. If this was a live video, I know many persons will be like, oh, don't rush, take your time, but we need to get it over with, because this is a YouTube video. Now, the second one would be liquidity is the objective. Do not run from it. Liquidity is the objective. Draw on liquidity. This would lead me to my explanation of drawn liquidity. Now, when I want to explain drawn liquidity, I explain it to my students in just one simple way. I dropped a PDF on drawn liquidity on my Telegram channel. So if you're watching this video and you're interested in the PDF, just go to my Telegram channel. You know my name, TechChrisTM. Once you search TechChrisTM on Telegram, you're going to find the channel. Go on my channel, search DOL. You'll find the book. That's if it has not been deleted already, because my channel is set to 3 months. After 3 months, the content disappear, right? But when I want to explain drawn liquidity to them, I need to first like build a candle. So I need to first design my own candle from the ground up. Now I'm going to call this on my red OB, and I'm going to mark a line in between it. I'm going to take this, bring this to the front. I need to send this to the back. Okay, I think it's behind already. So, and then I have the next candle. I'm going to call this on my green OB. Now, you're going to notice that something has happened here. This green candle has opened from here, because this is the opening price, and this is the closing price. has opened from here and has successfully broken above this high. Has broken above what? Has broken above the sell candle's high. Now this break alone has done something. This is going to be, this is the, let's say this is the candle, high and low. I'm going to take this to the back again. All right, so this candle has done something. Breaking above this high means that the market has switched directions. Now, there are two angles, or there are two places in this candle. There is what, this high, and there is this low. Many persons don't know this, but listen. When the market has done something like this, we call here the primary drawn liquidity, and we call here the secondary drawn liquidity. Price is very interested in what? Seeking the primary drawn liquidity. After price seeks the primary drawn liquidity and gives a chain instead of delivery, it can actually return to seek the what? Secondary drawn liquidity. But if for example price seeks the primary drawn liquidity and still closes above the primary drawn liquidity, we'll still have price keep claiming higher prices. Price will what? Keep claiming higher prices. That, I mean, I want to see the market open the new week, enter into the candle, seek points of interest, and a rally to take out the what's primary drawn liquidity. Or the market would open, seek the primary drawn liquidity, give a chain instead of delivery, and chase the secondary drawn liquidity. This pattern would happen over and over and over. Now, many persons ask me, oh, Tech Chris, where is the best place to actually look out for these candles and all of that? Before a new month, look out for it on the what? Monthly time frame. And before a new week, look out for it on the weekly time frame. And before a new day, look out for it on the daily time frame. That has solved your issue. All right, so liquidity is the target. Never fret from liquidity. Without liquidity, the market is not going to get to your target. Without liquidity, the market is not going to get to your target. Without liquidity, the market is not going to come to your entry. So we should appreciate liquidity much more than we do, right? We should appreciate liquidity much more than we do. Many persons say, oh, you are my liquidity, and they use it like some sort of like a slang now. It's truly something now in the trading community. Oh, you're my liquidity. Oh, I'm going to take your liquidity. Oh, your entry is my liquidity. And, it's like a caricature thing now, right? But liquidity is a blessing to traders. It's a blessing to traders. There are several forms of liquidity. Inducements, which I'll talk about later. Engineered liquidity. I think these two primarily, you just need these two and then you're good to go. What is an inducement? An inducement is the last low before the point of interest. If this is the point of interest here, an inducement will come before it, trapping traders who think here would come and become the point of interest. Meanwhile, the point of interest is what's just below it. While an engineered liquidity will happen in this way. Now, price will create an order block or a point of interest, and there will be a void. By void, I mean there is no form of liquidity here. There's going to be a void, and then what the market is going to do is that when it's coming down to take the point of interest, it would create like a fake out. Many persons will think, oh, the market is ready to go up now, and boom, it takes out these early buyers and then rally up. Here is the engineered liquidity, and this one is the inducement, I. So I used two charts to explain it a few days ago on my Twitter, and look at it here. Look at the points of interest. So I'm going to change this back to my order block. Look at the points of interest on the H4 time frame for Euro USD, right? Can you see that? Sorry guys. Can you see that there's been a void? There is no liquidity around here. Okay, there's no liquidity around here. Now see what the markets actually did. Now, price kept on coming down, and see what the market did. Tapped into the POI, right? In fact, it's here that would have been the engineered liquidity. Let me not use here because sometimes the market can tap once and go. The market just gave many persons benefit of doubt and came back again here. But that's not the true engineered liquidity. The engineered liquidity is this one here. Now, see what happened. The markets kept on coming down, then formed this week, and then the market broke structure here on the lower time frame. Now many persons would have thought, oh, the market got into a fair value around here and then it's ready to go up, but this low is a trap. This low is a trap. So, but anyways, if you actually know your POIs very well, you would have not been fazed by this move. It is people who are actually like in a hurry. There are some persons when they get into trades, they're in a hurry to like, oh, let me join FOMO. You know what FOMO is? Fear of missing out. Yeah, many persons get into a trade and then the FOMO, they want to just jump into the trade. Now, it is them that's going to get caught up in this thing, because the market is going to come to your entry no matter what. As long as you've marked out your POI correctly, the market is going to come. And what did it do? It literally came back to the entry, mitigated a point of interest, and ran to very good profits. Like, if you are on this trade, you're in for a lot of money, because this is like 5-hour trade. If you leverage this on your MT5 or your MT4, you're in for very good cash. You're in for about $500 on a $100 risk, $5,000 on a $1,000 risk, without even stressing yourself and trading major time frames. Now, this thing happens over and over and over and over. It happened one time on US 30. It happened on US 30. It happened here. This is the inducement, the last low before what's this point of interest. It happens almost everywhere. Okay? It happens everywhere. So we should appreciate liquidity much more than we actually do. Liquidity is what sponsors the market to go in our direction. Liquidity is what actually validates our points of interest. If there is no liquidity, there is no valid point of interest. Before I first said, if there is no market structure, there is no bias, there's no direction. For liquidity, if there is no liquidity, there is no valid point of interest. You need to know that there must be a source of liquidity sponsoring not just the entry but the targets. The targets, I explained it with the drawn liquidity. Find it on my channel if you're interested in making 2026 a better year for yourself before the channel actually deletes the PDF. Now, the third one, we are still in 3 and we've gotten to 22 minutes. The third one is I'm going to start rushing the whole thing because I don't want the video to exceed 40 minutes so that it's fun to watch back and it's fun to actually play. Or we can do it in parts. The third one is inducement is not manipulation, it's preparation. Inducement is not manipulation, it's preparation. I've even used the video on liquidity, on the points on liquidity to explain everything. Inducement is not manipulation, it is preparation. So if you find an inducement close to your entry, understand that the reason that inducement there is to actually help your entry. Is to help your entry, right? Now, the fourth one is other blocks only work in context. Now, when I teach, the one thing I note when I teach students is this. I teach them other blocks, or many persons, you go and learn what another block is. If I ask anybody, what is another block? They say, oh, it's the last bearish candle before the bullish break of structure. That's what everybody has been fed. That's what we've been taught. It's the last bullish candle before the bearish break of structure. It's the last, and all of that. They only work in context. Trust me, there are so many other blocks on this single chart. This single chart we are staring at now, there are many of them, plenty of them, but they only work in context. The context is your other block is in line with the direction of the market. Is there a form of liquidity that is validating it? Is it being mitigated? These are the contexts you should be asking yourself. A mitigation is a fulfillment of the entire orders on another block, or it is the removal of the entire orders on another block or on a point of interest. So if that particular point of interest has been mitigated, it becomes bare. It becomes empty. It becomes empty. It becomes empty. Okay? So you need to know that other blocks only work in context. Now, how do you actually get towards pick out the best points of interest for yourself? This one is a tip that's going to save you. An order block is formed when a minor or a major break has happened. If we have a minor break like this on lower time frame, what we call CSD, this particular break has formed another block. Another block is anything below here. Anything below here is another block. Now, when this happens on the major time frame break, another block is formed here. Now, all you need to do is wait for something. When it has formed the high and the market is dropping down, okay? Get your gun box 2, mark from point A to point B. That's from the lowest point before the break and the highest point after the break. If you do not know how to set your Gann box tool to look like mine, the ash region is the what? Is the premium. The lighter region is what? The discount. Okay. So if you want to set yours, see mine, you can just screenshot or screen grab and set yours like that. It only shows 3 points, 0.51, and you can also use the color. This is the color, 100% black. This one is 0% black, and this one is what? 0% ash, the third color. Background, opacity, and all of that. So, okay. So the first things first, you need to find your order blocks on. You need to find the order blocks on the discount area. So you're going to be focusing only on the discount area, right? When you are focused on that discount area, okay, you need to ask yourself, this discount area is there an existence of any unmitigated points of interest? First, understand that you need to focus on the discount area. If there are no points of interest that are unmitigated, price will most likely continue from the premium, which means price is going to most likely do what? Price is going to most likely just buy from the premium. But if there is an existence of an unmitigated POI somewhere here, the market is going to drop down into that point of interest, mitigate it, and keep going up. So mitigation is important for the context of order blocks. I said I was going to make a video on mitigation. I've not had time for it because it's going to be a longer video too. Mitigation is important. Knowing your premium and discount zone is important. And then finally, liquidity, a form of liquidity, either engineered liquidity or inducement. These three things, when you've mastered them, POI selection becomes a breeze for you. I said what? POI selection becomes a breeze for you. So order blocks only work in context. When you see order blocks lying anywhere they are, don't just jump in. Don't just jump in. Another thing I would like to also point out is if you have indicators that mark out fair value gaps for you like this, when price has mitigated a fair value gap and formed another block, it's also one of the strongest order blocks because the market is going to come back, use that order block and continue. Something like this. This mitigated its fair value. The market came back to use it. This mitigated its fair value. The market came back to use it. Can you see that? So you need to actually also understand that. Now we're going to move to our fifth point. Premium and discount zones decide direction. I've already said it. I've taught it in order block. The premium and discount zone decides direction. The market would buy or sell from the discount level. If and only if, because there's going to be a constant, if and only if the points of interest that rests on the discount levels are unmitigated. If these points of interest are not mitigated already, the market is going to proceed from the premium. So you need to always understand that there are contexts to everything, right? Now, the sixth one is the time frame alignment multiplies probability. This one, I'm going to be sharing a huge secret for you. Before you go into a new month, this is why I always keep posting on my X platform. Before you go into a new month, make sure you have checked what did the previous month candle do. Because even with the new month candle, you already have an inference, or you already know what the new month is going to look like. Okay? You already know what the new month is going to look like by just knowing what the past month did. If you're going into a new week, me and my trading pattern, we have a ritual, right? Not a ritual. We have like a ritual. When we want to analyze for a new week, we first start off from the weekly time frame. When you want to analyze for a new month, we first start off from the monthly time frame. When we want to analyze for a new day, we first start off from the daily time frame. Understanding what the past day has done would give you an insight to what the new day would do. Right? So time frame alignment multiplies probability. If you find structure or if you find clarity on the 4-hour time frame, guess where you're going to find your entry? If you find clarity on the 4-hour time frame, you'll most likely find your highest probabilistic entry on the M15. If you find clarity on the monthly time frame, you're going to find your most probabilistic entry on the 1-day time frame. If you find clarity on the 1-week time frame, you're going to find your most probabilistic entry on the H4. Hope you're taking notes. Hope you're taking notes. All right, moving to the 7th one. Session timing matters more than entries. Price works in a very fixed algorithm. Price and time. Time and price. Now, I made a video for you guys. This one requires we go to the lower time frame, so forgive me. I made a video for you people last time. That video has over 70,000 views on session trading with market sessions, right? And if you actually paid attention during that particular video, you would have got a lot of trades this week, because like this week printed so much session trades, right? At least 2. Okay, now if you've not watched that video, just go and search lower time frame trading on my YouTube. You're going to find the video. Now this is one that in fact I was very distracted this week. I didn't really see this one. Now this is one that happened on Euro USD. Now this is the Asian session low. Okay, this is the Asian session low. This was around 6 o'clock in the morning when the Asian session closed. The market swept the Asian session low. Swept the Asian session low into a point of interest, the fair value gap, right? Into a point of interest, the fair value gap. After it swept it, what did it do? It gave a change in state of delivery. Many of you don't still understand. The change in state of delivery is when price closes above this high. That's the change in state of delivery. And on top of that, what did this still give? This is the change in state of delivery. Now, most persons, if you do not understand POY selection, if you don't understand POY selection, to avoid missing entries, this is where I advise you put your entry on that CSD line. Just put your entry there. Okay? Put your entry there. And then your stop loss below the sweep. Target minimum 1:5 or 1:3, depending on what you actually trade. But I target minimum 1:5. So this is where I would have gotten out of the trade. Although you have to also trade in context. Don't just go and be telling yourself, well, I must target 1:5. The market can get 1:3 and let you be. But one thing about me, when I'm trading, when I trade, I have to look at roadblocks above. If the roadblocks above are going to prevent my trade from getting to 1:5, I would just rather sit it out. Okay, so but this is comfortably 1:5. If you leverage this on your MT5 or your MT4, you're going to be in for crazy ass money. You're going to be in for a lot of money. 5 hour easily. Now, this is for those of you who do not know how to actually mark out what your CSD. Just mark it from the line, that break. Now, for those who actually know how to mark out points of interest, you're going to agree with me that this is our entry. This is our entry. And our entry is also induced. This is an inducement. Our entry is induced. You can call it IND. Our entry is induced. And we have, in fact, we are going to be out before before those persons who cannot mark out would even learn to mark out. Around this area, I would have been out from the trade. Just understanding time and price. And these things happen, or let's say you took it up to this place, which I don't think I can. This is already a 10-hour trade easily. A 10-hour trade easily. Trading with structure on lower time frames. A 10-hour trade. If I had leveraged this on my MT5, if I was paying attention so much, this would have easily been a 20k payout. But anyways, I'm not sad because I got what I wanted from GBP JPY. You cannot actually have it all, right? You can't have it all. So yes, now it happened again on a Friday, right? The market also swept this this London session this time around, right? Because now it swept this it swept here. You need to also understand here, it swept here, but there was no change in state of delivery above here. So it didn't work. Now, but where did it happen? The market actually, see here again, it swept here, no change in state of delivery here. Until it swept here. This was where we now had a change in state of delivery around here. Now, what did the market do? This is our entry. This is our order block. This is our order block. This is our entry. I don't think this one gets to 1:5, but this is a 1:5. So the market didn't really reach 1:5 before. It didn't really, did it reach? I think it would have if you actually kept your stop loss very. This is like 1:5 hour. Trading with session. So this is not a session video. This is not a session video. You can actually go to that video. Just type lower time frame trading on my page. You're going to find the video, right? But you can see that the market actually works in a fixed algorithm: time and price, time and price, time and price, time and price. Many of you would have taken the entry from here, right? Would have taken the entry from here because you saw your other block here. But those people who know time and price would still join you because, like I said, when price taps on any point of interest, it gives you a re-entry. This is why I myself and students who I taught, we don't rush entries. An entry will come. Even if you say, oh, it has mitigated, or you don't leave you go, don't mind them. Don't mind them. To come back. It will give you a minor change instead of delivery, and the market will come back and it will mitigate you. No matter how far it has run, it will come back. Don't rush. As long as you've marked out a confident point of interest, it will come back. So that is point 7. Point 8, correlated instruments reveal intents. Now I had to force this one into my channel folks' head. I had to force it down into their heads. When we talk about correlated instrument, the popular ones I like to consider is what? JPYX and DXY. Because if you look at my new watch list, you're going to see DXY right above Euro USD and GP USD. Why did I put it that way? Because DXY is the index or is the correlated pair that would give me the strength for the Euro USD and GP USD. In essence, I'm trying to say that when GBP USD is going down or when Euro USD is going down, it means DXY is strong. The DXY is the what? United States dollar. This is it. DXY. DXY. It determines the strength of the dollar. So when DXY goes up, anything that has USD at the back, automatically goes down. And when DXY goes down, or when it's dropping, anything that has USD at the back goes up. So if you actually want to take buy trades on Euro USD, you need to actually first go and check DXY. What is DXY doing at the moment? It's just like a chart. It's like a chart. So if you know how to analyze your normal charts, you can analyze this one as well. It's a normal chart as well, and it follows the same principles. So you need to be able to understand correlated instruments. Now, another very, very interesting correlated instrument that I'm very thankful for this year because I made a lot of money with JPYs is with the JPYX. Now, the JPYX is just like the DXY. When the JPYX is up, anything that has JPY behind it automatically is going down. And when the JPY is down, anything that has JPY at the back of it, just like GBP JPY, USD JPY, Euro JPY, CAD JPY, what again am I missing? NZD JPY, AUD JPY, anything that has JPY behind it automatically goes up when the JPYX is down, just like DXY. So I had an analysis, a very beautiful one, a few days ago. Where I sold, sorry, this is a new analysis, sorry, I'm taking it off, okay. So this was where I sold JPYX from. Although you cannot really sell it to as per sell it on brokers. I don't think, although there's some brokers that allows trading it, some of them, and it comes as JPY basket on them. But this is where I sold it from. This was a 7-hour trade. But I didn't really take advantage of what it did here. Where did I actually take advantage of it? I took advantage of it on the GBP JPY. I've done a breakdown on TikTok on an IG. If you're in countries that ban TikTok, check my IG reel. The recent videos, one of them has GBP JPY on them, right? Watch that video. You're going to see how I was able to actually pull out an 18k payout from this particular move, right? From this particular move. So that was just all. I just needed to see the JPYX bearish, and I was going to go long on what the other JPYs. I had this beautiful buy on GBP USD JPY. It didn't get to TP and it said dropping back. So I have just forgotten this one. I would have made a breakdown on it, but it happens. It was GBP JPY that was doing better. So this JPY and DXY correlated pair, just understanding their correlation has helped me make a lot of money. So please, if you're going to print it out, print it if you must. Print it if you must. Okay? Print it if you must. Correlated instruments correlated what? Instruments show intent in price. So that's to say, if we actually want to go long on Euro USD, it means that DXY is going to go down. And if we want to go short on Euro USD, it means that DXY is actually what? Strong. It's as simple as that. As simple as that. So now these remaining lessons, I finished the lessons I wanted to talk about on the charts, right? These remaining lessons are just like psychological lessons. So we're going to go through them one by one. Now the ninth one is your edge must be executable under stress, right? There are some of us who actually found that under stress, and it's actually understandable. Many of us found that under stress. But if you cannot actually perform under stress, then you have a psychological problem you need to actually look into, right? You need to look into. You have a psychological problem you need to look into. If your system fails when you're emotional, it's not an edge. If your system fails when you're emotional, it's not an edge. So if it gets to times where you're taking so much losses and you start to tell yourself, oh, my system is failing, then that was never an edge to begin with. It was never an edge to begin with. The 10th one. Now, overtrading is discipline failure, not a strategy issue. If you find yourself clicking buttons because, you can find yourself in this situation where we have this whole ass downtrend and you're trying to buy. Every brick you're going in and the market's stopping you out. Every brick you're going in, the market's stopping you out. Every brick you're going in, the market's stopping you out. That is not a strategy issue. That's a discipline failure. You knew you shouldn't have traded, but you did anyways. You knew you shouldn't have traded, but you did anyway. So if overtrading is your problem, then you have a discipline failure. Now the 11th one is risk management is your real alpha. Risk management is your real alpha. Your entries can do so much but to get you into the trade. But risk keeps you alive. Now I'm going to share a very, very, I will not say start story, but a moment of learning for me. A few weeks ago, I got into a very crazy ass drawdown trading. I think I got emotional and I was trading because we are human beings. No matter how much you try to actually prove that these things are above us, you fall short in some ways. So I'm sharing you a true story as a trader too. I got emotional at some point and then I fumbled a lot of things and I got into a very crazy ass drawdown. Like 8%, I'll be 9%. And what saved me from that drawdown is my risk management. In fact, it took me 3 trades to come back to break even. 3 solid good trades to come back to break even. That's where I'm going to end it. Entries can do so much, but to get into the trade, risk management is what keeps you alive. Now, if you ever find yourself in a situation where you're in a very deep ass drawdown, and what comes to your mind is, oh, let me now go all in with the remaining amount left. If you do that, you're going straight to the village. If you do that, you're going straight to the village. Straight. Now, the 12th one. Prop firm rule exposes weak traders. Now, I'm not going to say so much on this one, but I'm going to tell you for a fact, I respect every trader who trades prop firms. When I see you trade prop firms and you make money from prop firms, I have this very high respect for you because it is not easy trading under these restrictive conditions. If your strategy can survive something like max drawdown rules, you're a pro. You're a pro. You're a pro. And the funny thing about prop firms is that prop firms has actually helped me also have a very, very personal view on my personal account equity. I treat my own personal account like prop firms. I have max drawdowns. For my own personal accounts, I have daily drawdowns. For my own personal accounts, the knowledge of prop firms has helped me a lot. So we're not going to spend time on that. Many of us know it's the truth. The 13th one, now journaling is how you find leaks. I remember starting Forex and I was actually doing so much of journaling. In fact, my starting Forex days was very funny because I had a book then. I can't even find the book anymore. I would have read a few funny things to you people. I had a book then that I was writing things. I was trying to study the Forex pairs because I was still into crypto, so I was trying to migrate into Forex. And I was trying to do some studying, and I picked up my jotter, and whenever I take a loss, I write it down. Oh, what was my reason for my loss? Where did I take a loss? What day did I take a loss? Because I would like to also note down the day so that I can come back to that day and then find it. Right? The reason why I also took that loss. So I did it with Euro USD and XA USD. I did it with both of them, and that journaling. Let me just cut it short. That journaling alone helped me find a lot of leaks in my strategy. And I just knew that, okay, no, this crypto knowledge, I could not bring it into Forex. I could not bring it into Forex, else I'm going to get myself in very big trouble. So if you don't have data, no improvements. For traders who are starting out, you need to journal. Even if it means manual journaling. Right now, I use TradeZilla to journal. It's a bit expensive for some persons, but I use TradeZilla to journal my trades and other things, right? There are better options there that might actually be cheaper, but the one I currently use is TradeZilla to journal my trades automatically for me. I just connect my accounts to TradeZilla and it journals everything I do, and I come back to review, right? So, but if you cannot afford TradeZilla, you can go for that better option. Like I said, I started with like manual journaling. So number 14. One setup beats 5 half understood ones. Depth beats variety anytime, any day. If you have a solid understanding that when the market actually creates a liquidity sweep, changes in state of delivery, and forms an inducement before it, and this is your POY. If you trade only this or sample only this across 20 trades, you're going to find out that you may actually just see it on 10 is a lot. You may see it on just 2 or 3 trades or 3 of those pairs. But whenever you take them, what happens is a banger. And then it comes to tell you one fact. Depth beats variety. It's not about knowing so much. But that particular one how in depth do you trust that it's going to actually play out fine if you actually come across a bad market condition? There are a couple setups that I actually have. In fact, there's one thing me and my trading partner, we used to like make jest of ourselves. Whenever we miss a trade, we tell ourselves, is this not our edge? Why did we miss it? Well, what was the reason why? Were we not paying attention? Because I've been very busy of recent trying to finish some stuff I have, physical things. So when we see these things, we keep on asking ourselves, is this not our edge? And the funny thing about our edge is whenever we see our edge, it never fails. So it will pay you to know one thing that works 1,000 times over and over, that has a very, 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 very slim chance of failing, than over 100 things that you're not even quite sure if they're going to play out. Over 100 things, you come and tell yourself, this one, if I said this one is going to now come and stop me out. Are you sure this one is going to play out today? This one stopped me out last week. Are you sure it's going to work this time around? Stop that. Stop it. Depth would always beat variety. Anytime, any day. Number 15 rather. Drawdowns are information, not punishment. They show you what breaks under pressure. Because when it comes to trading, there are 3 major aspects of it. The technical analysis is one, which is your edge. The psychology is the next. And then the last one is your risk management, right? So when you start facing drawdowns, it gives you time to question yourself. What am I doing wrong? Am I being too emotional? Is it psychological? Is it my edge? Or is it discipline issue? Or is it risk management? Am I risking much more than I actually am supposed to risk? Now, I'm going to share a personal story. A student of mine would come and make jest about wanting to marry a girl like that, and he had an FTMO account, 200k one, and he got it funded, and then came back after a few weeks to say he has blown the account. Obviously, we make jests on our group, and I was like, is there a man that pressured you to blow the account? And everybody laughed. But I told him, please just send your MT5 history screenshot. Let us see. And then that's where you basically find out two things. I found out two things: over trading, number one, and the second one, inappropriate risk management. You know the situation where the market tries to convince you that, oh, Omo, you're right, oh, please, I just took you out a little bit, come back in, and you jump back into that setup. Sorry for you. This was also happening to this boy, but he could not see it because he was being too emotional. He was being driven by the losses were scary. The losses were scary. Take one loss, the market convinces you, oh, no, I'm ready to move now, please come in again. And you jump in. It takes you out. Oh, no, sorry. I was just playing around. Come in again this time around. Don't worry. It's going to go fine. And you jump in again and boom. It just takes out your entire portfolio. This was essentially what he was doing. Risking more than 2K on an FTMO account. And taking so many setups in a day. So drawdowns are information, not punishment. They show you what to break under pressure. 16. Backtesting without forward testing is fantasy. The markets are dynamic. Your edge must adapt with it. I've said this one. I don't know how to actually say it and you understand it. If you backtest alone and you don't forward test, you're wasting your time. By forward test, I mean trading actual markets that are forming live. Even if you're not executing, but you're just actually engaging, right? The one thing I'm going to advise anybody is after you have finished your backtesting, let's say you've come to the US, you've backtested this entire data, and you see that, oh, my strategy worked out so many times. Leave that your strategy. Let's get to forward testing. Move to the beginning, move to the current position of the chart. When the market opens, join us. Let us see if you're going to be able to get good. Because it's one thing to actually see something that has happened after it has happened. And it's one thing to actually see that thing happening and engage in it. When you can see it happening and engage in it, trust me, you've become better than you think you can ever be. So, for backtesting without forward testing is fantasy. Markets are dynamic, so your edge must adapt with it. 17. You do not need daily trades to make yearly money. Professionals wait and amateurs force. Now, this one is very interesting. Okay? This one is very interesting. And I used to tell my students this every day. Because when my private class was starting, the private class starts only May, every year, May. Every year, May. So, when I got the set of private students, because I told them that I was going to be trading with them, they were only interested in just trading and making the money. And I was like, none of you is interested in learning. Right? None of you is interested in learning. And there's one thing I'll always tell them. Truth. The market is not running anywhere. The market is not running anywhere. There is no amount you think you're going to make that you cannot make in the future. As long as we have life or life persists, there is always going to be a new opportunity. As long as these candles open every Monday and close every Friday, my brother, my sisters, you're going to be able to make money from this market as long as you want. You're going to be able to make money from this market for as long as you want. Learn first, earn later. Learn first, earn later. This is one thing I tell them. There's no amount of money you're chasing today that you're not going to even see double of it tomorrow if you've understood how the market truly works. So all you need to do is you need to condition yourself to first calming down. Let me calm down and understand what the market is doing first before I jump in. Number 18. Scaling too early kills your account. Now, many persons actually have this problem too. They want to jump into scaling too early. And there was a tweet I made out one time. I said, if it's not time for you to scale, you would know. If you're a very conscious person, you would know. Or the simple one I tell my channel folks is, if you can make a payout from a single account 3 times, 4 times, you're ready to scale. At that point, it's no longer luck. At that point, it's no longer luck. You can see it's proof of work. If you've made 3 to 4 payouts from one account, at that point, it's no longer luck. You can replicate it on a bigger account. But if you just made your first payout and you're thinking of, oh, let me go and use the money and buy a bigger account, you may lose that account you're buying and also the one that gave you the payout. Stay in one place first. Do it consistently. Scale afterwards. Size comes after consistency. End. Number 19. The news doesn't create the direction, structure does. Now, this one is going to be very, very interesting because many persons think the news manipulates them. Oh, they took me out of the trade. Oh, the market manipulated me out. Oh, the market has done this. The market has done that. Oh, I was stopped out. Who are you? I. Who are you? Who do you think you are? The market manipulated me out of this position. Market. Do you have a vendetta against the market? Now, if you actually check back 25 markets news releases, you're going to find out that the market actually did not stop you out. The market actually moved in the direction of the higher time frame. The market actually moved only in the direction of the higher time frame. Only in the direction of the higher time frame. Price, I told my trading partner this. Every 8 o'clock when there is a news, that's in Nigeria WAT, when there's a news on GPUSD, look at what it does. It expands to a point of interest. And when it expands to that point of interest, it takes out all of those persons who have been on the trade for, doesn't it? It does. It takes out every other person who has been on that trade for a while. Right? So, news does not create direction. News only fuels direction. The news only accelerates what has already been planned. Number 20, psychology shows up after losses, no wins. There is no single person who will tell me, oh, because I'm winning, I need to check my psychology. Story for the gods. Anyone can trade when they are winning. Anybody can trade when they are winning. If you get into trading today and you start winning, you can keep trading forever and ever. So your psychology, your need to improve your psychology only shows up after losses, not wins. Trust me. There was a time I went on the 2 months winning streak. At that point, I felt like everybody was under me. I felt like, oh, the whole world was revolving around me. Oh, I could make any amount I want. Oh, until the losses came. And I started asking myself, is it psychology this time around? Is it risk management? Is it technical issues? So your psychology can only show up after losses, after a few losses, not when you're winning. Anybody can trade when winning. Now, to 21. Screenshots are marketing, statements are reality, process over perception. Now, this one is confusing because I would always tell my friends this. If I share you a trade, be rest assured I have also executed that trade. If I show you a screenshot, be rest assured I have taken advantage of that trade before I show you. I have so many trades that I took that I have not shared. Oh, sorry. I took that I have not shared. I took a trade on NAS 100 from here. And the price has not gotten to take profit yet. Have you seen TechRisk post it? No. So, screenshots are just for marketing purposes. Statements are reality. Focus on making money from trading. Stop focusing on impressing people. Improvement over validation. Focus on improving, not proving. Focus on improving, not proving. Number 22. Boredom is a sign of maturity. If you're entertained by trading, you're doing it wrong. 23. Most traders fail because they refuse to simplify. Complexity feeds ego, not profit. I see some people, they want to even solve equations on their charts. It's crazy. And I'm like, look at my charts. Please, everybody, look at it. What don't you understand from all of these things I've marked? Please help me, look at it. Every trader knows who I've marked. But there are some persons who will come, they'll start solving derivative equation. Yx plus z plus hyphen 1 equals to lambda t ogive whatever. And you look at the whole thing and it looks so complex and it looks so beautiful, so complex, and you think the person has figured it out. Rubbish. 24. Your routine determines your results. If you have no structure in real life, you have no structure on the charts. This is why the most disciplined people in real life, the most disciplined people I know in real life, they succeed in trading. The most disciplined people I know in real life, they succeed in trading. People who have a routine in real life. I know when when I want to teach a person and I know this person right from time, I know this person is going to actually do well. My senior brother works in the bank, and when he will come and tell me, oh, he wants to learn how to trade, in my mind, I already know this thing, you can't do it. I grew up with you, I know the kind of person you are. You can't do it. You have a discipline issue. That is it. Now then, finally, number 25. 2025 rewarded execution, not information. Everyone has knowledge now. Everybody knows what concepts are. Everybody knows what concepts are. Only very few can execute these concepts cleanly. 2025 rewarded those who executed, those who took advantage. Everybody, like I said, have knowledge. Everybody knows every concept. Everybody now. There's no concept you can ask now that they don't know. SMCA, they know it. CRT, they know it. Which other concept again? MBBMM, whatever, they know it. Everything. Beats the market maker, they know it. Market business model, they know. They know everything. But 2025 rewarded specifically those who took advantage. So if you know all these things and you're yet to take advantage, it's a sign that in 2026 you need to wake up. The more you trade, the better you become. The more you trade, the better you become. This rule applies to every trader. The more you trade, the better you become. You cannot get better without executing. You can't. You can't get better without executing. And that leads me to the end of this particular video. In 2026 rather, we are going to actually see very beautiful price action. I honestly cannot wait for the new year. It's going to come with so many opportunities. It's going to see you move from the level you are at to a new level if you're ready to take action today. 2026 is going to see a better version of you. 2026 is going to see cleaner price actions if you know what you're doing. The 2026 charts will confuse you if you're already confused in 2025. The markets will change so drastically that if you do not study frequently, you're going to be left behind. And trust me, 2026 can end the same for you like 2025 if you refuse to bend your heads down and do the right things. 2026 is going to be a great year for you if you make it one. And these are my 25 lessons I had to learn in 2025 that helped me become a better trader, helped me make so much money, and I'm just entirely grateful for the new year. And I cannot wait to see what comes out of I have so much hopes for 2025, and I have hopes for you too. My plan in 2025 is simple. For the first time, I don't think I need anything out of life but good health, better price action. Let's make more money. I'm going to try to keep up videos, so many videos in 2026. So if you've been on this channel, in fact, I saw some person send me YouTube Wrapped and they were number 1 on the channel. If you've been number 1 on the channel, next year, just turn on your notifications for this channel, because I may be uploading frequently, and I will not be informing. I'll not, because when I upload, I inform on my Twitter, on my Telegram that I've uploaded a new video. But from 2026, I will not be informing of any new uploads. I'll just upload and then let the algorithm send the video to whoever is interested in it. Those persons who have the notifications unmuted will get to benefit from all the videos. I love you, and I cannot wait to see what you achieve in 2026. Have a blissful end of the year ahead. Take care and goodbye.